I'm Paul Kent. I'm the founder and managing director at Sureswipe.
Welcome to the African Tech Roundup, Paul.
Great. Good to be here, Andile. Thanks.
Well, perhaps let's start with a little bit about you and the journey that leads you here to, speaking to me about a startup you founded and one that's operating in the payment space.
Yeah, I think our journey is a little bit different to others. We started not within a garage, but within another company. I was working at Healthbridge at the time. We really found a need in the doctor market where a lot of the medical benefits, the private benefits in South Africa were changing, and doctors needed to move from just medical insurance claims through to other mechanisms of payment. And we were in a good timing. We partnered with a bank, Capitec, who were really looking just to get into that space. So we put a product extension to our existing business, and we had a little bit of success there. And the idea came out of that to take it out of healthcare into the broader market, because we saw a need for independent retailers really to have decent fees at a very, very good service levels, which they weren't getting from the major banks at the time.
I'm going to want us to come back to this because the notion of corporate bred innovation is one that interests me. And I think one at a lot of companies across the continent are trying to engineer in some way or form, and definitely worth talking about. But tell me a little bit about what Sureswipe does.
So Sureswipe, in 2008 when we entered, there was only 4 banks that could provide merchant services, which is really ability for businesses to accept credit and debit card payments. Smaller merchants, what we term independent retailers, they were underserviced and overcharged as much as 5-6% at the time. And to get an installation at a small merchant, it took up to 30 days. If there was a problem with the machine, with the hardware, which, 10 years ago was quite common, it would take 7 days to come and fix and repair that machine. So there's a lot of revenue lost for these independents. And, small businesses, you just take out a small part of their revenue, and they really, they're survivalists.
Yeah. And you're talking about the sort of size and scale of business, which typically might have only one machine, for instance, as opposed to a Pick and Pay or, some other larger retailer that have like 7. So if one stops working, no problem.
Yeah, sure. That's exactly it. And even to the point where businesses that were a certain turnover, the banks actually declined them because they just didn't have the number of transactions to go through those machines that made it economically viable for the banks at that stage.
Similar to how the banks continue to go about deciding where to put an ATM, for example. Only neighborhoods and areas that can sort of guarantee the bank the sort of transaction traffic that justifies the investment, right?
Yeah, that's exactly it. But part of it is, you need to get an economic return. That's part of doing business. But I think what the banks do very differently to the likes of Sureswipe is they run very expensive infrastructure. They run very expensive services. They've got those wonderful big buildings that they pay a lot of rent for. And we really look at how do we operate something at a real decent operating cost in order for us to provide services to that smaller, more independent merchants that really need those services.
For the benefit of people who aren't familiar with the South African payment space or familiar with the continent in general, how would you go about describing your products and perhaps cite some global examples of, I suppose, lookalikes, if you like?
I think everyone will be familiar with if they've got a bank account, they've got a bank card. So the product itself is quite simple. It's a simple card machine that goes into retailers. You go in, instead of paying cash, you pull out your credit card or your debit card, you swipe that or you insert it, put in your PIN, and the transaction's processed. So it's a commoditized product, to be honest, around the world. In South Africa, it's been very dominated and protected by the 4 large banks. And in 2008 was the first time that it really started opening up and letting what we would call payment service providers, non-acquirers or non-financial institutions, the ability to start acquiring on behalf of those independents. So where we would provide the sales, the service, the support, but we still get into the banking infrastructure via a sponsored bank. So it almost gives the best of 2 worlds. You've got this agile company offering wonderful service, big distribution and sales teams, but you still get the protection and the security of the Reserve Bank or the central bank infrastructure.
So what changed several years ago to allow players like you in? I was speaking to an investor, recently who reckons that this space is entirely ripe for consolidation because of the commoditization you referenced. And he reckons that's because, it's a space race for brand recognition, brand ubiquity, perhaps even critical mass by some other metrics. So two questions at once. What changed to let you in? And is this investor I've been speaking to right about his perception of the space?
So I think the biggest change was Capitec Bank got what at the time was what they call a acquiring license. So before that, they were just issuing cards and issuing accounts. And then they started acquiring transactions from retailers. And they were quite open because they wanted to get critical mass quite quickly. They were open to work with a independent, which is typically a sales organization at that stage. So that was one of the critical moments of us starting. Before that, there was probably one player in the market doing something similar, and quite rapidly it opened up, and the banks started opening up, realizing the benefit of having sales organizations on the ground. And now there's probably 30 payment service providers, either in store or what we'd call physical card acceptance, and or online.
What do you make of this notion that this area is ripe for consolidation?
So I think, mentioning there's probably 30, maybe more payment service providers. Scale is critical in this space. So a lot of them will be either survivalists. They may be breaking even at best, year on year. So it's probably getting to a stage where those independents are ripe for consolidation, for acquisition. And I mean, we're one of them that's looking at that and trying to drive that.
Let's go back to something you touched on earlier, which is, how the company was born. And I've said on the show before that visitors to the sort of startup ecosystems in Johannesburg and Cape Town, for example, would be remiss if they didn't appreciate that some of the best innovation won't be found at the local co-working hub or in some of the obvious places that run these tours to come visit and see, look and see or show and tell and that kind of thing. And not to knock what's happening there, because I'm sure there's good work happening, some startups worth, taking a sniff at. But I would hazard that there's a lot of underground activity that's happening within organizations, within, corporate incumbents, in perhaps some of the greener, leafier suburbs of both Johannesburg and Cape Town, in places that, one wouldn't necessarily visit if they came in town for a quote unquote innovation tour. So with that sort of backdrop set, talk me through, several years ago when you were starting up, what was your role within, the holding company that allowed you to spawn this idea, grow it out, and then later spin it out?
It's wonderful for a company to start within another business. I think the one is it gave us such security around roles, around financial security. A lot of that does come out of spinning a business from an existing company. One of the difficult parts is often they try to keep that business within. And I think one of the biggest successes that we had at Sureswipe is they allowed us to become an independent organization, not a department within another company. So it really became a self-standing business unit. And I think that was one of the key things that we did at the time, and something that we try and do at Sureswipe. We've got, although we provide merchant payment facilities, we do other products that we add on because we've got this wonderful customer base, and we try and get that same level of entrepreneurship coming out of a division that it's got its own balance sheet, its own income statement, but it's got some of that security of having a mothership.
Do you remember some of the things you had to negotiate with your exco, with your board, in terms of like getting started? Did you sell them the vision of a standalone business at the time, or were you smart enough to realize that kill it if they heard anything like that?
Funny enough, I didn't start the product. called Sureswipe. It was one of my colleagues, that's actually our CIO, Stephen LaRue. He was on that project team. Another ex-colleague, David Reinders, he was on the product team that actually built the product, negotiated, got the contracts in place with Capitec, and then kind of handed it over to a sales team that was selling healthcare, switching, and Sureswipe merchant services. And it was kind of doing all right. But I think the opportunity that we saw was that it's got to be outside of just healthcare. So the decision was made at a management level. I can't remember what triggered off the discussion, but it was probably something like, we needed to do something different to hit targets. And one of the ideas was, well, let's spin Sureswipe off and not just go into the medical field, but into the broader retail. And that triggered the idea of a separate business unit called Sureswipe.
So there are a lot of innovation architects, hub runners listening to us now, a lot of corporate professionals who inhabit that role within large incumbents. It's a big deal now to try and manufacture the kind of innovation that, Healthbridge has successfully spawned in Sureswipe. So give them some advice on how to handle mavericks like you, or spot the potential of mavericks like you who might not necessarily be in the organization yet.
Yeah, I think it was. And coming having a secure job, for me, having a secure job at that time, there was a little bit of a nudge and a push from other, part of the Manco team that without that, maybe I wouldn't have jumped into it so wholeheartedly. But the biggest component was really around that independence. Really got to break the ties, allow them the ability to do things their way. Often it's, well, this is how we do it at a corporate level. So you've got to do that at a startup, and a startup is completely different. And we have, even at Sureswipe, we're going through that same thing now, where we've got some really new business units that are being hindered by Sureswipe's need for resources, development, etc. And they kind of get put to the bottom of the pile. And I think the real key element for it was that just allowed us to go free, make our own decisions, and cap it with some commitment to some funding. We were quite fortunate. We looked at, from a startup, the product was built, or a MVP was built, and I guess the philosophy that I had taken it out there wasn't to build the most amazing product. It was say, well, we've got something good enough to sell, and we try to build an amazing sales arm. You can have the best product in the world, but if you can't sell it, you're not going to be successful. And then we kind of went the other way around. Let's get a product out there, which fortunately at the time, people were a little bit more open to not having the perfect product available. Much more difficult if someone was starting in the payment sector now. You've got to have the full, complete product ready. So I think time to market was important for us.
What year are we talking here?
2008.
Yeah. So were there any hard lines, or perhaps lines drawn in the sand during that period around this has to work by such and such a time, or we need to see results of such and such a nature in order to justify continued investment, etc.?
So we were fortunate. We didn't have those discussions, and we got to the point in year one, we were cash flow positive. So it was like just an amazing success story, going from, we started with probably 200 customers that we brought across from the healthcare, from Healthbridge. And within the first year, we were funding ourselves.
So let's talk about Healthbridge, so that, we have the full picture. For people who don't understand or know about Healthbridge, give us a sense of what that company does, again, to help us join the dots in terms of the birthing story of this company, of Sureswipe.
So I think Healthbridge started from an entrepreneurial journey as well. It was 1999, I think it was. It started, and really at that stage, you can think about claims between a medical practice and a medical insurer were either sent through paper, which was the most common, or the real tech-savvy ones used to, batch it and send an electronic batch, EDI batch, at the end of every day or every week. So Healthbridge came into the market, putting in what we call real-time claims, processing directly into the insurer. So the doctor had, whether would send it immediately as you leave the doctor's practice. He would get a response saying that it would be guaranteed to be paid. And that was the real core of this real-time response coming from the medical insurers, confirming, first of all, that it's a valid patient, but also confirming that they've got an insurance benefit available to make good on that payment. Instead of having to either send something into the ether and wait till you get a response from a paper claim, or phoning up the insurer to say, does Paul have insurance? It was actually just done part of the software system.
What would you say has been the greatest departure from the initial vision that's part of your core offering now?
I think HealthBridge was very much a technology company, and sales were needed as a means to, of course, you have to sell your product out there. But from an organizational point of view, they were really into technology, business workflows within doctors' practices. We saw things a lot more simple. We think card payments, card acceptance is a commoditized product. And so to differentiate at a technology level, at a product level, at the time was virtually impossible. So it really started talking about setting up the business as a sales and service organization. And that was kind of the big difference between the HealthBridge as the technology company and Sureswipe, which was real sales and marketing company.
And so when you think about when you first started out and now a decade later, what would you say has been the biggest innovation on that notion? Pivot maybe, or moonshot?
Yeah, so we now payments has become much more technology driven. At the time it was card only. Contactless has come in, but it's still card. But we're really seeing a lot now in QR payments. We're looking at digital POS systems with MPOS connected to that. So very much cheaper devices that are in the market. And we've moved certainly from a sales organization to much more, we run our own technology stacks now. So we build our own products, or we licensing products, packaging them and bringing them to market. But we still go back to, we've got more than one product to sell now because we've got an MPOS solution. We've got the traditional card machines that you see in most retailers. We also integrate directly into point of sale vendors. So
MPOS being a mobile payment portal, right?
That's exactly it. So it's that little card device that talks via Bluetooth to a mobile device. Square in the US is probably the perfect example to use. iZettle in Europe.
And so tell me how you think about potential collaborators, potential clients, potential licensors. What filter do you use to evaluate the market for those different groups? Given how no one's staying in their lane and you're in a highly commoditized space, how do you know that you're not putting yourself in a partnership situation or a licensing situation that will essentially disrupt your business?
Yes. So we think about it from a client point of view, from a customer. So if we think about the product that we started with, yes, it can be used across a multitude of size customers, but it's not optimal. So we really looked and said for independent retailers that do small volume, kind of look at it, volume of transactions, a standalone device is perfect. But if you have a higher volume business, quick service restaurants, for example, multi-stores, if you're slightly larger independent, maybe you've got ambitions to open more than one store, franchise out. Really, you want more control over the transaction speed. You want to reduce your admin burden, and that then you start getting payments integrated into your point of sale system. And that's a real, it's a much better product for that type of business. And then on the other scale, we really looked at saying, if we really want to expand our target market, we've got to go look into the smaller, more informal types of businesses that in South Africa can't afford the $20 or the 400 Rand rental fee for a traditional standalone payment terminal. And that's where MPOS came into play. And so we really looked around, if we wanted not just to expand our client base, but expand the target market, we looked at getting different products that suit the different business needs. So that's how we looked at it from a product point of view, and then how we picked our suppliers. Lots of suppliers around the world. For MPOS, we were fortunate. In the early days, we looked at a few companies and found actually a company called Handpoint. They operate out of Iceland, and they've got an office in London. They've got, they do a license agreement around in different parts of the world, but we licensed their technology for South Africa, and it was already up and running in other markets. So localizing it for South Africa it's never easy, but it did give us a sense of comfort that it would give us speed to market.
So I suppose I'm also just thinking in terms of your origin story, the partnership with Capitec Bank. I imagine partnerships with big scale players like that would be important for growth. That's kind of what I had more in mind when I asked the question. I'm wondering, what your business development cycle might look like, how you prioritize key accounts or key partnerships, and how important partnering with people with existing scale or, reach within the market, et cetera, et cetera. How does that factor into your strategy?
Yes. So Capitec was, from getting off the ground, was an amazing bank, an amazing partner to work with. They gave us the sponsorship we need. They gave us the rails into the banking infrastructure. We no longer use them as a sponsor. We had for the first 5 years, and they taught us a lot about banking, a lot about acquiring. And for us, starting in the market as almost one of the first payment service providers, having that known brand behind us was definitely needed.
Sorry, let's just contextualize. Capitec in South Africa, a lot of people rating Capitec as arguably the biggest disruptive influence in mainstream banking, retail banking here in South Africa, to come out in a long time, to take on the likes of First National Bank, Nedbank, ABSA certainly, and Standard Bank, helping to popularize mining the green fields for business growth at a time when the bigger banks couldn't be bothered, or frankly, when they could be bothered, couldn't figure out a way to do so profitably or, profitably enough. So yeah, I don't know if I've sort of created a backdrop that's suitable for someone who doesn't know the market.
Yeah, I mean, Capitec were amazing bringing banking to the mass consumers. They do it at R5 an account, I think, is something like that these days. But they're really consumer focused. So for them to get into acquiring, which is actually business focused, was an unusual step. But I think, they plan in the long term and really went into it. So at some point they'll be getting into business banking, not just consumers, and it'll be interesting to see what they do there. But for us, going into an independent store, imagine coming into a retailer, we're talking about Sureswipe. We want to put our card machine in there and manage your funds. It's like, the most trusted thing you need is the money that flows through your accounts to be secure. So as a retailer back in 2008, this was just unheard of that a non-bank is trying to offer this service. I mean, to the point, I'll never forget, probably 2009, I think I got a call from one of our sales agents. He was in the back of a police van, and he'd been pitching the business to a small restaurant, and two off-duty police officers were having lunch at the restaurant and heard this story and thought, doesn't sound right. Only banks can offer that service, and literally threw him in the back of the van. And he had to phone me to try and explain to the policeman that, no, we're a legitimate business offering a legitimate service. So
that's a crazy story.
Yeah. So we had some of those, some great stories like that in the early days. And that's when we leaned a lot on Capitec as a brand, just to build up some of the credibility until either Sureswipe was well known or it become more common for non-banks to offer merchant services.
So from a regulatory standpoint, are you a financial services company? At which point do you transition from a technological enabler or, service provider to a financial services entity?
We're hindered at this stage to get into provide the full financial services. The Payment Association of South Africa and the Reserve Bank rules don't allow it. So we're still dependent on a bank. We're still dependent to process via Visa, MasterCard via a banking platform. So from a regulatory point of view, we have what we call a sponsor bank. They provide the rails into the banking infrastructure, and they provide the regulatory oversight that's needed for a payment service provider to operate.
So founders listening to us right now, that's probably a key piece of this puzzle, where it's like you could have this amazing dream or innovation in this space. Only so many ways to crack this nut, it sounds like.
You still have to be friends with the large banks at this stage. And I think it's going to be like that for a while. You know, innovation is an amazing thing and it can enable a lot, but we're still in the banking world. We're dealing with people's money. So there's this fine balance between risk and innovation. We often think that the regulator is behind, but there's a role to play there. So now we partner with Mercantile Bank Limited.
Why would you have mentioned MasterCard?
So MasterCard are the issuer, MasterCard and Visa, the two main issuers in South Africa. So even though the bank would put a card out on a bank account, it's still underwritten by a MasterCard or a Visa association.
Gotcha. Okay. So let's talk a little bit about the numbers. Give me a sense of how big you are. You mentioned 200 when you first started out. How many active users do you have? Can you give us an indication of, how much money you're clearing, things of that nature, what it costs you to enlist a new client, those kind of things?
I think one of the biggest costs still is the onboarding of a new customer. We still have to go through what we call a FICA or KYC. So it's quite expensive process. It's still quite paper based to a large degree to get a full account open. So that's the costly part, and it's quite time consuming. Not so much for us, but for somebody opening a bank account to go and get all the paperwork that's needed it's usually not on hand. So that's one of the difficult parts, or kind of one of the challenges that we have to overcome. At the moment, we've got around 10,000 merchants on our books, and this last 12 months, we did just under 11 billion in transaction value. So it sounds a lot, but in terms of a market share, it's less than 2% of the market share. Then if you throw cash into still the real biggest tender for payment, it's less than 1% market share.
That's the thing. I love that you said that we go by oversimplification as the enemy here. And for every story we hear about mobile money and M-Pesa and other, good things, too few people are mentioning that the biggest incumbent is cash.
Sure, it's still our biggest competitor, really is. And in South Africa, we're quite different in SA compared to a lot of other markets, where here we're not hindered by the number of bank accounts open or the number of cards in circulation. I think about 80 million was the last time I looked at this. So for every economic active person, there's probably 2.5 cards available. So we're unlike a lot of other African countries in particular. They don't have a lot of cards in circulation. They're still trying to get people to get a bank account. Here that problem's been solved primarily. So it really becomes about the ability to use your card in such a way that becomes into habit. And I think that's the biggest struggle here is, how do you change the habit of going to an ATM, drawing out your money that you've got to spend for the week? It's easy to manage it. I've spent 100, I've got 200 left for the week. It becomes habitual, and that's how you manage your budget. And getting the change in that habit is, I think, the biggest factor to reduce cash.
I think it's that, and the fact that the banks are still charging way more than they should for the privilege of being able to transact on your own account.
From a merchant point of view, I think since we've come into the market, fees to merchant discount fees, merchant acquiring fees, which is a percentage of the transaction, it's more than halved in 10 years.
No small thanks to Capitec.
This is not Capitec. This is really the payment service providers. So Capitec on the consumer side, I think, has done an amazing thing for bank accounts and the cost of a bank account in terms of
You're talking merchant fees. Okay.
I'm talking merchant fees for a retailer. Those fees from payment service providers such as ourselves and others that are out there really brought competition to the market for the first time, and fees they've just over half.
Is that an admission that we've been overcharged for ages and for no apparent reason?
Sure. You put an oligopoly in any market and fees go up and service goes down. And that's what it was for many, many years.
Yeah. So, make a case for why plastic isn't going away, though. So many technologies to point at, the disruptive influence of mobile money, led by and large by telcos who have taken advantage of their big scale advantages. And of course, their massive books of business and standing infrastructure to essentially disrupt finance. And then of course, startups in the space who will not be, deterred by their lack of a financial services license or anything of the sort, to come up with great ideas and basically make mobile money a thing in a way that it hasn't been for the last 10 years. So in the context of that trend, and I haven't even touched on decentralized technologies like blockchain and crypto and other things, why is plastic a thing in your mind?
I think the associations or the manufacturers or the proponents of plastic in 1970 or the late 70s were talking about cash disappearing, and we certainly haven't seen that happen. So there's a place for new technology, and there's no doubt. And the thing I like about new technology is it's not going to replace plastic. It may replace some of it. A lot of it focuses on replacing cash. But really what it is doing is it's changing the interaction between the customer and the retailer. And instead of a one-size-fits-all credit card into a card machine, the customer experience is changing. For example, you'll be sitting at your restaurant and you can definitely pay from your phone. It's a much simpler, less friction in terms of a client experience. So I don't think that plastic is broken for many events, and with contactless there now, it really is to take out your card, tap it against a machine and walk away. That's going to be around for a long, long time until the technology gets there that makes it more convenient, because the real driver of a change in technology is about convenience to the consumer. And sometimes these new technologies that are out at the moment, it's clunky. That, when you're in a queue at a teller, it's a clunky experience to pull out your phone, open the app, and try and make a payment with that. Samsung Pay, probably the closest to getting it right, certainly in South Africa.
So I was going to say, right, there's obviously, competitors to exactly what you do, the likes of Ikoka, perhaps Yoko, but then there's also SnapScan, and there's, you've mentioned Samsung Pay, and perhaps what Amazon is trying to induct by owning an entire platform of value where, frankly, just stay in this ecosystem. Like, what do you see as the biggest potential disruption to where you are now? Okay. And I use the word disruption carefully. I just say maybe competitive technology or trend, to where you are now. And then think in terms of your roadmap or your platform roadmap. I assume you must have one. Talk about what's influencing, that strategy or that vision.
So Amazon is doing some amazing stuff, which I think from an South African point of view, it's years away. And one of the biggest hindrance in that space is the cost of setup. It's $160,000, I think, $180,000 was the last cost to set up a Amazon Go store.
So they represent the ultimate platform play, right? So we're a long ways from there, but where are we in fact, and what's closer home, if you like?
So and then it gets to really around, we're very excited about the likes of Samsung Pay and that type of technology coming here, because what that's really doing is it's increasing the use of a card. It's just a different way to present the same thing. And all of our devices, our technology that's set up is for acceptance of, I'm going to say, electronic tender of different kinds. And that's how we see our role to play. The smaller merchant or the independent retailer, Zapper, SnapScan, which is really the QR codes. The challenges that they have with that is they need a contract with a bank or Sureswipe for acceptance of card. They need a contract with SnapScan. They need a contract with Zapper, and multiple contracts, multiple settlements, increased complexity, increased time to recon. So what happens is, from a business owner point of view, and one of the biggest challenges a small business has is access to time. So this level of complexity is just creating more and more admin and reducing the time that they have to work on their business. So what we see as the role of Sureswipe or the others is really to sit in front of that and be an aggregator for all legal tender. maybe not cash, but certainly from all digital, where we can present it in a way what's very easy for the retailer, very easy from a recon point of view, and really just simplifying their life.
And so from that standpoint, really the notion of a crypto-led future, or, a virtual contract-led future is no threat to your business per se in that context.
As long as we have the ability to accept it as a mechanism of payment and present it in a way that the retailer can use as part of his in-store experience.
So presumably a future where the agreements you have currently with like MasterCard, you might have at some point similar agreements with the likes of Luno as an exchange, as a crypto exchange, for example.
Yeah, that's exactly the future that we're talking about. So, Bitcoin or another type of cryptocurrency can be a legal tender. They'll come in and they'll need a way to accept it. They'll need a way to make sure that it gets transferred into their account, and they'll need a trusted source that can provide the information where a retailer can do the recon that what I'm getting paid is what was promised to me either yesterday or today.
So because you and I both live in Africa, you told me you've got about 10,000 active merchants right now. I know just how impressive that number is because we live here. And because I know where we are in terms of, the digital transformation journey we're on as a continent. How much pressure are you under to justify, this growth story, or to create a growth story that matches stuff that we've come to expect from startups that are venture backed and sort of surfing growth that it's just spurred on by, conspicuous spending on paid acquisition of customers and things of that nature. I suppose I'm trying to get into your startup founder's mindset in terms of gauging what was a good day today, whether this year we actually hit our targets, are we growing fast enough? Are we making enough money? Is our bottom line sufficient? How much are we reinvesting? Give me a sense of, your thinking around that.
So we've been quite fortunate because we started from a trading company, from Healthbridge. And they still are a majority shareholder. We haven't had the expectations of outside investors, private equity investors, VC investors. So from that point of view, it's been a lot of self-driven around what are the expectations coming out of Sureswipe and our team. And part of that is we've got to get a balance. I think it's, we can get lots of devices out in the market. We can open up lots of accounts, but we've got to get the right balance between devices out there and use on those devices. Because from an annuity point of view, one is it could be a once-off sale or it could be a rental, but the revenue is really earned through how that device is used. So what's the transaction value going through our base of our estate of devices?
Can I just pause you there? Like, what sort of value are you gleaning from that? So what are you making on the average transaction? How much are you relying on, the fees you charge for the use of your devices? How much of your model relies on the actual transactions?
So for us, it's around 78% of our revenue is annuity based on transactions. So if the December, of course, a wonderful time at Christmas where people go and spend in store, for us, that's an amazing month. We'll do, last year, December, we did over R1 billion in 1 month. This December will probably be about 1.4. That's the expectation. Even in a very depressed economic market in South Africa where retail is down for the year, we still expect a very good December coming up.
So what do you take on the rand?
So it's a percentage base. So around, it's a competitive information.
Well, listen, I have to ask.
I think if we look at it from an industry point of view, when we first started, industry average was around 4.5%. I think the industry average now is somewhere between 2.2 and 2.4%.
And you're doing better than that?
Around there.
Right? A shame. I am putting him on the spot, but I got to do the job.
No, I mean, I of course I can answer kind of where we fit from a pricing point of view. We're very competitive as a business, and it depends on the size of the merchant. So it depends on the transaction fees that go through. Our standard pricing is sliding scale. So you start if you're only doing 10,000 Rand or $1,000 a month, it starts at one price. But if your value increases, automatically your fees go down. So from that point of view, that's kind of how the pricing model works. It's a very competitive market. We're almost into a price taker market. So we compete with the major banks at a pricing point of view, and then we just offer much better service levels.
Okay, so that was a really long detour, but back to your psyche as a founder. How do you balance your personal expectations for where this business needs to go, how quickly it needs to grow? You're probably benchmarking against the likes of Yoko, who are taking on venture capital and obviously, ramping up that way, and you probably look sideways and go, what should we be doing? Back into that.
Yeah, so Yoko have done amazing. They've got a wonderful story. I think 25,000 devices in the market in 5 years. It's a really, really wonderful story. And
except we don't know what it's costing them. We don't know if it's sustainable. Again, because they're venture backed. Lots of cards held to their chest and so on. I have no idea how good a story that is, given some of the fundamentals I've described.
The key thing you look at, and that's kind of where I mentioned earlier, for us, it's not about the number of devices we get out there. It's about the transaction we get through those devices. So they talk about 25,000 devices or so. So they're 3 times the number of devices that we have in the market. They're probably 20% of the transaction value on an annual basis. So that'll just give some context into that type of business. But they operate in a very, very unique market, which is really the more informal entry-level devices, entry-level merchants, and they're moving slightly up the value. But typically, their merchants are doing very, very little transaction value. It's just a matter of selling a card machine, which is really around hardware sales. So fortunately, we're not driven by the number of accounts we open or the number of devices we get in the market. We really look at it from a transaction value through the value through those devices and what gross profit and net profit we can make on that. So what are the real returns to shareholders?
And from what I can tell so far, from what I know about your business, no real pressure to go multi-market anytime soon across the continent. Give me your thoughts about when or when not to take that step.
So we've always taken a little bit of a fast follower. I'm not sure outside of e-com. I think some e-commerce have some wonderful examples around the continent of success there. Not as many in terms of in-store card acceptance or physical card present, because of this this almost a blue ocean but very, very unknown market space in Africa. And this fast follower approach that we've often had, we'll wait to see what success others have first before we go outside the borders. And we've got no pressure from our shareholders. They're really looking at saying, what is the best return they can get on the capital that they've got employed with us. And
no FOMO, because you've got to look at Nigeria and Ethiopia, the East African region, and just go in general and just go, maybe we should be over there.
Yeah, for sure. There's a wonderful opportunities in those markets, but we've got to think about and look back and say, we know the South African market really well. You do have, limited by the amount of resources you have, and whether that's financial resources or the people that you can bring on board quick enough to scale. It's one of the challenges we have. And as I said, we're 1% market share in South Africa, so opportunities here still it's immense.
So let's talk about your platform play, quote unquote, assuming you have one. I'm sitting in front of an empty whiteboard. Let's pretend this was a board meeting and you guys were vision casting for the next 5 years. What would be on that whiteboard? Would it be a lending play like Yoko's doing? Would it be a strategic merger or acquisition involving something like Luno or BitPesa? What are you betting on?
So we're betting on obviously it's a growth strategy still at this stage because of the opportunity that's there, and it's a combination of a few of those really. I think one is our current shareholders are in discussions to exit, and that will consolidate some of the players in this market, where we'd have the ability to really have a strong business focus on the different market segments in terms of the informal kind of independence and even into the tier 2, tier 1 retailers. So that's quite an exciting opportunity. It really brings, probably for the first time, that could bring the real scale into a payment service provider. that's the one side, and those conversations continue.
So it's a readjustment of your risk profile by basically allowing your major shareholders right now to exit so that, you can mess about without putting their investment at risk.
No, I just think, they've been wonderful shareholders, but it gets to a time where the requirements from a business point of view and the requirements of shareholders, they don't add up. So there's, as they exit, the preferred bidders have got, they've got access to new markets. They've got companies that they own within the South African market, and it's a great merger opportunity and a consolidation opportunity.
And hopefully your strategies are aligned with those new bidders.
That's exactly. So, and that's it. So that's on the, I guess, market consolidation side. So the probability of that happen is quite imminent. From a product point of view and kind of a product roadmap or a platform roadmap that you talk about, we really look at things like, from an independent retailer, what are the things that they struggle with most? Cost of banking, cost of acquiring was a massive problem for retailers, and it still is. So we're still looking at ways, how do we get that cost down? And that's one problem we're in the process of solving. The other one is really around allowing independent retailers the ability to communicate with their customers, to provide loyalty programs, to provide market insights, client insights. So that's something that we're looking at, and we've got a product out there. It's probably still in a MVP stage, but certainly it's a gift and loyalty product that allows small retailers to communicate and market products to their customers. And then finally, we partnered with Retail Capital, one of the initial merchant cash advance companies. So we partnered with them 4 years ago. So we've got quite a successful lending book in collaboration with Retail Capital already.
Here's an idea for you that you're welcome to steal. I mean, we've had on the show folks from a company called Zing Holdings. Be interesting if a player like you did something in the token space as a means to scaling. That would be interesting, dabbling in remittances, perhaps. I don't know.
When you talk tokens, what do you mean by tokens?
So Zing essentially, and I'll share the link with you afterwards, but Zing essentially allows, for now, Zimbabwean citizens based here looking to remit funds via their platform. They have a registered entity here, one in Mauritius and obviously one in Zimbabwe. You buy their tokens via an app, and essentially through that ecosystem, you are able to effectively transact across borders via these tokens that you essentially buy on their platform. So again, a very clever solve for borderless trade, or at least a trade that would have otherwise been inhibited by very expensive borders and controls.
Yeah, sure. And I think one of the things we do have is we've got 10,000 points of presence out there, and certainly from a enablement point of view, we do have the ability to turn those acceptance points into any kind of digital tokens. So yeah, they could be sold in store, or people can go in and buy the token through one of our card machines, and we can facilitate the payment. I
bet you the folks at Zing are listening to you going, why are you well, you were on the show a couple of weeks ago. It's your fault.
No,
or maybe you guys should just get together and merge.
Yeah, we often looking at saying, we've got this 10,000 devices, points of presence out there. How can we capitalize on those as assets? So open to all discussions.
It must be really exciting to be you right now. I mean, anyone in a well-run organization within this space, in a well-run business in this space. Good businesses are generally hard to come by, but being positioned to take advantage of a couple of key trends, big data, remittances, payments, all these wonderful things that potentially can take us, from 0 to 1 as a continent in terms of digital transformation, must be a really exciting time. To be a fly on the wall in your boardroom would be fun. But I want to thank you so much for being on the show. Is there anything you haven't been asked that you wish people would probe, but just in interviews never quite get there?
Yeah, it's great. I'm glad you did, because I think I've got one, and it's really around, there's a lot of hype in fintech, and there's a lot of hype in technology companies, and I often say to the team, we try and have a lot of fun in this business, and part of the reason for that is we are although we're in a payment, finance, or technology space, we're actually retailers, and we keep retail hours. And so we're always on. So it's a quite, it sounds very sexy in fintech and payments, but it's tough being always on 24/7 because that's when our clients operate. And so to counter that, we try and make sure we have a lot of fun in the business.
So tell me though, you've just given me one last question I have to ask around this hype question, which is you must have pet peeves. When you read, the PR journalism in the space or the hype journalism in the space, and there must be things that leap out at you and just go, for me, it's the phrase leapfrog or the word leapfrog. It just annoys me. But I mean, what grates you or impact investment? That's my other bugbear, when it's lazily unpacked or put forward. Like what in your space doesn't sit well with you in terms of the realities of working in the trenches of the industry you're in versus the perception out there?
Yeah, I mean, I don't think it's anything to do with the hype of any of the interviewers or any of the journalists. It's really for us, what irks me really is around the inability for the regulator to keep pace with innovation, and the weak spot on transactions, in my view, is still the bank. And we're forced to go via banks into the rails for processing, but from a reliability of product to the consumer and to our customer, who's really the retailer, they're still the weakest link.
Well, we will leave it here. Thank you so much, Paul Kent, founder and CEO of Sureswipe. Thank you so much for your time, man.
Thank you.